Welcome back everyone. In the previous videos we talked about the original function of derivatives, and then we deepened the theoretical approach to practical reality. Today we will talk about three other concepts of particular importance: fair value, volumes, and open interest. The fair value, or fair price, represents the theoretical value of a financial asset compared with its market price. We want to check whether the market price is overestimating or underestimating the correct value of the financial asset. Let's understand the concept of fair value of a derivative contract such as the future. The price of the future makes impossible the convenience of arbitrage operations between the underlying and the derivative. The value of the future is equal to the underlying index value at expiration date and the weighted average of all the stocks that make it up. The price of the derivative has a direct relationship with the underlying index. As the index grows, the price of the derivative contract also increases. So, why the value of the index is sometimes different from the value of the derivative? Simple. The index is composed of stocks that are defined as spot contracts, where the price is settled immediately. The derivative is a forward contract, where the price is settled in the future. If we want to check the fair value of a future that is based on an index of stocks, we have to account the effect of dividends. Derivatives traders know that the future price is net of dividends. The higher the dividends expected on the future expiration, the lower the value of the future will be. Another factor that affects the fair value of a derivative, of course, is its time to maturity. Time is the variable connected to the concept of uncertainty on the future value of the index. The greater the time to maturity, the greater the time value. That is the risk that the future value of the index will deviate from the current value. According to the factors that determine the theoretical price of the future, index price, interest rate, dividend, time to expiration, it is not difficult to calculate the fair value of a 3-month expiration future. Let's make an example. An index price is worth 3,000, interest rate equal to 1%, and dividends at about 4%. We must add the index price, 3,000, by the result of multiplying the difference between the interest rate and the dividend rate, 1% minus 4% equals minus 3%, by the number of days of duration, 90, divided by the total days of a calendar year, 365, or 90 divided by 365 equals 0.24657. The total that comes out is the fair value, and which in this example is equal to minus 22.19, which added to 3,000 and rounded up to the higher value sends us back to a 3-month future price of 29.77. So if now is March, while the index is 3,000, the June future beats 29.77. At this point we must remember that the difference of these 23 points between the index and the future will gradually tend to zero. It will be zero on the day of expiration of the future. The trend of market price deviates more or less from its theoretical value, not linearly, but asymmetrically. This asymmetry of the price could give rise to an arbitrage that would allow to buy the undervalued asset and sell the overvalued asset, feeling confident that somewhere in time within 3 months, an alignment of values will occur. In today's markets, it is almost never possible to make such arbitrages due to market efficiency. The other two concepts of particular importance are volumes and open interest. Volumes are the number of transactions carried out in a given period of time, and they indicate the liquidity of a given financial asset. Higher volumes mean greater liquidity. Few volumes means that the title is not liquid, and probably the bid-ask spreads are wider. For example, John opens 2 futures contracts with Jack. John sells 1 contract to Paul. Paul sells 1 contract to Bill. John closes 1 future contract with Jack. Volume, 5. The volumes, however, do not represent so much, if not the liquidity of the stock and the price area where the trades take place. If we want to read the market effectively, we have to study the open interest. The open interest represents the number of contracts left open on the market after a trading day. It is the amount of cash of the operators still at risk. The open interest can increase, decrease, or remain unchanged. The open interest is a number greater than 0 that increases with the opening of a new contract, decreases with the closing of a contract. In the example above, the open interest at the end of the day is 1, despite the trades were 5. So, the open interest is very different from the volume. The volumes are just market negotiations. The open interest instead represents the facts, the outstanding contracts after a day of negotiations. The reading of the open interests is very important, and we will deepen the analysis of these data in the next video lessons. Thanks for watching, and see you soon.